I'm Justin Rowe-Roberts of BizNews, and with me today is hedge fund guru and Protea Capital Management founder Jean-Pierre Verster. David Shapiro is on his way back from the United States as our regular Monday Power Hour, and he'll be joining us a bit later in the week. But Jean-Pierre, always great to catch up. Whilst we're on the topic of the United States, Fed Jerome Powell spoke at the Jackson Hole Summit on Friday, which was one of the most eagerly anticipated Fed meetings in a while. What were the main takeaways, and how has the market subsequently reacted to that meeting?
Thanks, Justin. Yes, well, the market took it as a positive sign, and the JSE was, except for Nasdaq this morning, up on the back of Jackson Hole late on Friday afternoon, and the S&P 500 was up as well. So the big takeaway for me is that it's almost like Goldilocks' porridge, not too hot, not too cold. So on the one hand, Jerome Powell said that they're going to taper the open market operations, the buying back of bonds. So that means we are nearing the end of quantitative easing. But on the other hand, that does not mean that they're going to raise interest rates anytime soon. So you have this perfect Goldilocks scenario where interest rates are probably going to stay lower for longer, even though we are coming to the end of tapering. And that is positive for equity markets. It means money is going to stay cheap, and therefore risk assets have done well on the back of that announcement.
And is it healthy for financial markets to have such a reliance on accommodative monetary policy, as we've seen from Fed Jerome Powell in the last 18 months?
I don't believe it is. No, not at all. We are all like junkies, and we need to get our fix. And every time you get your fix, it becomes less effective, and you need a bigger dose the next time around. So this is exactly this weird and wonderful macroeconomic world we are in, where central banks have really embarked on experimental policy, and it isn't healthy. But it's almost a case of them saying, well, maybe the alternative is even less healthy for the world economy. If it wasn't for central bankers, imagine how bad unemployment and pricing stability would be, and maybe we would all be in a big recession. And of course, the big a very difficult question to answer is, by trying to avoid that, trying to avoid smaller recessions, are you perhaps creating a doozy of a recession maybe in the future? And look, no one can say this for sure, but the warning signs are there. And Japan is the one example about what could happen to the rest of the world's economy. And if you look at Japan's economy over the last 30 years, it's not a pretty sight. So we're just hoping that the central bankers know what they are doing, because if they don't, we're all going to be Japanified very time soon.
That sounds very daunting coming from you, Jean-Pierre. Late last week, I did speak to Sibanye-Stillwater CEO Neil Froneman after they released their results. He said he'll be watching the Jackson Hole Summit with intent due to his business's interest in gold. A question that was probably for him, but I'm sure you won't do a bad job at answering: would commodity counters be interested in what is said at the Fed meeting?
Yes, commodity markets would be interested. Commodity markets do well when interest rates are low, but they do even better when inflation expectations pick up and people try to hedge the fact that money might be worth less in future by buying hard assets, by buying commodities. So the Jackson Hole announcement was on the one hand good, but on the other hand bad for commodities. Good because interest rates seem like they're going to be lower for longer, but bad because it also indicated that they could be lower for longer because there's no big threat of inflation. So on balance, I actually think Jackson Hole wasn't that good for commodity markets in general, because it did indicate that maybe inflation, like we're seeing right now in economic data, is transitory, and therefore that it's not such a big long-term problem, and that isn't great for commodity markets.
Different topic altogether. I'm not interested in those numbers as a standalone, and rather looking at the industry as a whole. There's very little doubt that hospitality has been the most negatively affected industry by the pandemic. But what's your long-term outlook for the industry?
Yes, indeed. And look, there was a base effect. So if you look at the numbers that Sun International came out with today, they all show very high growth rates. But don't be fooled by that base effect. The hospitality industry, whether hotels or casinos, are still having a torrid time. So I'm not positive on the industry as a whole, But I do think that some of the, not necessarily large casinos, but what we call alternative gaming outlets, the bingo halls and the like, which are smaller venues, could actually continue to take market share from the big casinos and take market share from conferencing and other ways in which people spend money out of leisure. And therefore, that's the one bright spark in Sun International's results and in the hospitality industry, the smaller gambling, alternative gambling type places. But on balance, still a lot of concern for the hospitality industry currently.
With the emergence of new variants, and I saw one today on Twitter, and many governments' draconian-like pandemic regulations, this isn't just unique to South Africa. We've seen what's currently happening in Australia and New Zealand. Do you think travel and leisure will ever return to pre-pandemic levels?
Well, never say never, but I do think it will probably take a long time. So whether it is commercial airplane flights, not for business, but for leisure, whether it is hotels and resorts, cruise ship operators, a lot of these businesses are just holding on until things normalize. And it looks like they will probably need to hold on for a little while longer because of these new variants. And I just hope that they aren't too serious variants and that the vaccines are still effective against them. But yes, that is why money is kept so cheap by central bankers, to help these companies to just hold on. And the cost of holding on and waiting is not very high. So as long as there's some light at the end of the tunnel, we'll be okay. But it looks like we'll need to wait for that light to appear. It's not going to be anytime soon.
Mass Real Estate also out with the results this morning. Again, not too interested in Mass's results as a standalone, given they're predominantly Eastern European focused. However, South African listed property has been the biggest loser in the last 3 years. Negative rental reversions, high debt levels. As a fund manager, is this a sector you'd be long or short, specifically in the South African REIT context?
We've been short the last 3 to 4 years in the SA REIT sector, and we've done well out of that. But in the last few months, we've slowly but surely closed a lot of our shorts, and we are more neutral on the sector. Here and there are certain pockets of interesting opportunities where we have some longs. We see some corporate action in the sector now. There's been a few announcements. The most recent one is Resilient, for instance, taking a stake or proposing a stake in the Pula. There's also some corporate action between Fairvest and Arrowhead. So there's some activity happening, but I think we're in the early stages of a turnaround in the property market. Things are still very tough. You mentioned the negative reversions. You know, whenever your lease comes up for renewal and you can renew at 10 to 20% lower, that's not the type of economics that's good for a REIT, for a landlord. So we are still cautious in the sector, but not as negative as we've been the last 3 to 4 years.
And lastly, Jean-Pierre, the concerns in China still linger, but it has calmed somewhat in the past 2 weeks. Are the powerhouses such as Tencent, Alibaba, and JD Group still attractive as investment propositions?
In broad terms, we believe so. We don't think that President Xi Jinping is going to kill the golden goose. That if he does want harmony, he makes sure that there's still economic prosperity. Yes, he wants that prosperity to be shared, to be a common prosperity, and to address inequality. And that means that some of the big, very profitable companies like the ones you mentioned, Tencent, JD Group, Alibaba, might see some pressure, need to do some work to reinvest back into more social aspects. But we do think for the long term that these are such good quality companies with such good positions in their markets that they'll weather the storm. And that ultimately it's a more sustainable business model to make sure that you are doing something that's good for society. Yes, still making a profit, but still making that in a sustainable and responsible way. So of the three you mentioned, our preference is Tencent, but we also own JD.com. We like JD.com a lot. Alibaba a bit less so. We do think the risks are a bit higher when it comes to the Alibaba business model and the people involved, and the fact that the Chinese government and regulators seem to be targeting Alibaba to some extent. But we do think there's a lot of opportunity in the Chinese market currently.
I'm Justin Rowe-Roberts of BizNews, and you've been listening to Protea Capital Management founder